Money Monday is sponsored by Husky Financial.
With inflation rates near 40-year highs, time to come in for a soft landing. Well, interest rates are on the rise, an attempt by the Fed to avoid another recession. Could this tactic work like it did in the 1990s? Well, let's find out and welcome certified financial advisor Karyn Cavanaugh of Carolina's Wealth Management. Great to have you.
Thank you.
All right, so let's just do a quick little history lesson if we can. So remind us what happened in 1994.
Interest rates went up, and we had high inflation, so Paul Volcker had no choice but to raise interest rates. And in raising interest rates so rapidly, he caused a recession. And that's the risk that we're facing right now, is that we have to raise interest rates to tame inflation, but we want to raise interest rates without putting the economy into recession. And that's kind of walking a tightrope, and that's a very difficult situation.
Yeah, you just took the words out of my mouth, because it sounds like, all right, so you're trying to avoid inflation, you're trying to avoid a recession. So what brought us to this place?
Well, inflation is caused by a supply and demand imbalance. And during COVID, we saw demand go through the roof. Everybody needed new things. We had nothing else to do. We had a lot of stimulus money out there, so demand went up, but supply also went down. And the supply chains were broken. We saw that, and we still see that. We're still grappling with that. So that's it. That was what really caused the inflation. And the Fed is going to raise interest rates. And raising interest rates isn't a magic wand that will just make inflation go away. By raising interest rates, he's going to tamp down demand. The Fed is going to tamp down demand. He's going to take liquidity out of the system. He's going to make borrowing rates higher. Investing rates are going to be higher. So that's going to put brakes on the economy. On the other hand, though, the Fed, Jerome Powell, can't really do anything about supply. Mm-hmm. So there is a fear out there that we can maybe push down demand, tamp down demand with higher interest rates, but if supply chains don't get repaired and we don't see supply coming on board, then we can have persistent high inflation. And that's high inflation, lower growth. That's the S word. That's stagflation.
Okay.
And that's what the worry is, and that's what's really been roiling markets lately is that worry that we're going to have lower growth, but we're going to have persistently high inflation.
Yeah, because I don't want to get too political with this conversation, but when we're talking about inflation, we're already seeing the cost of goods and services go up tremendously. I mean, certainly you go to the gas station and you pump some gas into your car, you're filling up for $100, whereas it was $50.
Right.
A couple of years ago. And so with that raise in prices, diesel even more so, well, we're paying for that fuel too. And so was it short-sighted when we're in the midst of COVID to shut down the Keystone Pipeline? Was it short-sighted to cut us off from some of these resources that could have kept at least some engines still pumping?
Unfortunately, it was economically short-sighted, and it's going to take a while for that to come back on board, even if we opened everything up. It's not just a turn of a switch where all of a sudden we have all kinds of supply. So we are going to see, especially with energy prices, we are going to see continued high prices in the energy sector. As for goods and services, I mean, it depends on what sector we're in, but we are seeing supply chains rebuild. We're seeing transportation get back on board. We're seeing some positive efforts there, but we also get a lot of our goods and services from China, and China has been locking down because of COVID. So supply chain disruptions are not over. They're still going to be with us for the next year, and that's going to be an issue, and it's going to be harder for the Fed and Jerome Powell to tame inflation when supply is not really coming on board.
Right. Let's talk about the interest rate for a moment. So it's been raised recently.
Yes.
So what is it currently?
Well, the Fed funds rate is up to 0.75. Okay. So, but we see mortgages now that are in the high 4s and 5s. So it depends on what end of the yield curve you're looking at. Right. Remember, the Fed can raise rates on the short end of the curve, but long end of the curve, that's more subject to market conditions.
Okay. What is the impact going to be then on the home buyer, on the home sales market? Because people are going to have a harder time qualifying for mortgages at a higher interest rate.
Right, especially the entry level buyers, because a lot of time they're looking at what the payment is, not just the overall price of the house. So that's going to slow down the market, especially for lower priced homes. And overall, I mean, the cost of borrowing is higher. So obviously that's going to slow things down. Now, the thing about the housing market is there's been a supply-demand imbalance for 10 years now. We haven't been building enough homes. So we've had a supply shortage. So prices have gone up, and last year home prices were up 18% year over year nationwide. So I think that home prices will still continue to move to the upside, but not at such a rapid pace, because really, I mean, there's just not, the affordability is just not there, and with higher interest rates, it is really going to take a bite out of affordability.
And what do you think this is going to mean for consumers in general, student loan borrowers, the job market? I know I'm kind of giving you a three-pronged question here, but what do you think this raising of the interest rate is going to have an impact on those three things?
Well, it is going to have an impact, because that's the whole point. Raising interest rates is supposed to put brakes on the economy. Yeah. So it's supposed to slow down borrowing. It's supposed to slow down the job market. It's supposed to slow down all the investments that makes the economy roll. And but the trick is to make it slow down, but not enough to push us into recession. And so that's what the Fed's job is going to be, is to try to slow down the economy, put the brakes on them, but not enough so that we really see the recession that we saw in the early 90s.
Right. Yeah. Well, I appreciate you bringing it back home and coming back to the whole idea of recession. If you had your crystal ball, what do you think is going to happen?
Well, you know, we just had 1 quarter of negative GDP. We may actually be in recession if this quarter is negative. There's so many unknowns out there. So I tell investors and clients that when there's so many unknowns out there, stick with what you know. And what you know is that companies are actually making money. We just got first quarter earnings, and company earnings were up 11% year over year. So when you see that, this isn't like 2007, 2008, where companies weren't making money year over year and the earnings were rolling over. We're seeing companies that are making money, and some companies are actually doing well in this environment. They're able to pass on price increases to the consumers, and consumers are going to continue to buy their products or services. So those are the companies that are going to do well in this environment. So I'm telling investors that you may be worried about what's going on in the economy and the market, but stick with what you know. And there are some companies that are doing well. So those are and we see that. I mean, we see earnings reports coming out all the time, and some companies are going to continue to do well. So
interesting. So interesting how this crazy world of finance works. Yeah. But as things continue to change, we would love to have you come back and continue this conversation.
Absolutely.
Thank you so much.
Thank you, Leila.
We're back after this.
Money Monday is sponsored by Husky Financial.